Hello folks, Steve Lentz here with Discover Options here at Option View Systems. Welcome to this presentation of three different market timing reports for advanced options traders. This will be for Friday, December 8th, getting ready for Monday's open on the 11th. Presented material is for educational purposes only and should not be construed as personalized financial advice. Past results are not necessarily indicative of future performance. Before we get going, I want to remind you to please subscribe. That way you get alerted to whenever we post new videos. And also, if you haven't already received this, we have a free ebook co-authored by myself and Jim Graham called Simple Steps to Options Trading Success. Just click the link, give us your information. We'll get that right out to you. Today we have three different reports, all three for the S&P 500 index. For advanced options traders trading condors and butterflies, we have the Butterfly Condor Timing Report. For those of you looking for put selling strategies on the S&P 500, we have the Bull Put Spread Timing Report. And then finally, for the statistically minded, we have the S&P 500 Directional Likelihood Report. Okay, let's go through these one at a time. But first, all three reports look at the current market condition of the S&P 500. And here's what we have in terms of three different dimensions of the market condition: price action, trend, and then the stochastic condition, overbought, oversold, etc. In terms of price action, we have two consecutive upswing bars that occurred, higher highs and higher lows, both on Thursday and on Friday. That occurred when the market is above its 50-day simple moving average, and the 15-3 stochastic is trending upward between 50 and 90. All right, now all that makes for a market condition that has occurred really quite a bit in the past. In fact, if you were to go all the way back to January of 2000, that market condition is just expressed as occurred roughly 285 times. 285 times, which is quite a bit. All right, that's quite a bit. And so compared to other market conditions that have had far fewer occurrences. So that's where we are at. Let's go to the first report, the Condor Butterfly Timing Report. This answers the question, based upon the current market condition and how much it's happened in the past, is now a good time to put on a Condor or a Butterfly campaign. All right, and so to answer that, here's the report. Since January of 2000, we've had 4,533 daily closes of the S&P 500. Now, of those 4,533, 65.6%, almost two-thirds, have been favorable bars for selling options premium, where the actual 21-bar movement was less than what was at the time being implied by the CBOE's skew-adjusted VIX. That is, the option prices. So once again, two-thirds of the time, the market ends up not moving as much as what is being implied by the options prices. And so that's our baseline statistic. Now let's go to the occurrences. So during that time, the current market condition I just detailed has occurred 285 times. Now, of those 285, 69.5% of the bars were similarly favorable for premium selling, as we just discussed. Now, that's a bit higher. That's a bit higher than the benchmark of two-thirds. So that implies then a premium selling edge of roughly 3.8%. So statistically, it's more likely than usual that our current market condition will end up being a favorable one for market-neutral option premium selling strategies like condors and butterflies. Okay, I hope that information is helpful for those of you trading that way. Let's now go to the Bull Put Spread Timing Report, and this presupposes that you're looking to sell put options a standard deviation away about 30 days out. All right, so here we go. We've had 4,533 closes of the SPX. Now, of those, 83.2% have been favorable bars for selling put premium, which I just explained, where the actual 21-bar downside movement was less than the CBOE skew adjusted implied movement to the downside. So in other words, what we do is we look at the VIX, and I use the CBOE's published skew figure to back into a downside VIX and an upside VIX. Okay? Because the out-of-the-money calls have a lower implied volatility than the out-of-the-money put options, right? So the implied move to the downside is going to be a bit higher than the implied move to the upside. So when we look at that implied move to the downside, 83.2% of the time, the market does not move that far. 16.8% of the time, it does move that far. So that's our benchmark. Then we go to our current market condition of 285. Of those 285 occurrences, 82.5% of the bars were similarly favorable, which is really close. That's within 1% of the benchmark, okay, of 83.2. So it's basically a wash, but nevertheless, I'll sum it up that this implies a put selling edge, a very slight one that is negative 0.7%. Okay, so statistically then, it's very, very slightly more likely than usual that Friday's bar and condition will end up being an unfavorable one for selling out of the money put premium. So, for those of you trading that way, take that for what it's worth. It's pretty much a wash. Okay, so hopefully you have an approach of selling puts and adjusting them, where adjusting your position where you can certainly make money on the benchmark approach, the benchmark statistics of 83.2. Okay, finally, let's go to the likelihood report. And what we do here is we answer the question based upon our current market condition and looking at its occurrence, in the past. Where is the market likely to go? Up, down, or wobble around for a bit? And to answer that question, we have to use what we call price distribution bands. Price distribution bands. And here's how it goes. I explain this, I know those of you that are on this every time, I am explaining this a bit every time, but that's okay. What we do is we take the close, we go above the close, a standard deviation 5 days out in this case. We go a standard deviation underneath the close, 5 days out, okay, and we look to see what the market does here. And the question is the market going to go up and hit the upper band, the lower band, or wobble around for a bit? Okay, now notice that the upside bands are a little closer to the close than the downside bands. And again, that's because the out-of-the-money calls have a lower implied volatility than the out-of-the-money puts. All right, so we keep these statistics for every close going back, all 4,500 plus. We keep those statistics, and we do this not only for the 5-day bands, but we go out 10 and 15 days as well. All right, so, and then we keep statistics on all 3 time frames. Then when you look at the report, here's what we have. We see that for the 4,533 occurrences, the upper 5-day band ended up getting struck 21.5% of the time. The upper 10-day band, almost 16, upper 15. The lower 5-day band, on the low side, on the downside, the lower 5-day band was struck 16.4% of the time. The lower 10, 16.6, and the lower 15, 19.4. So these are the benchmark levels. Now, let's now go to, in this case, the 200 occurrences. These are non-consecutive occurrences. Okay, so the previous of 285 include consecutive occurrences. We are wiping out the consecutive occurrences and just using the original ones here. Okay, of those 200 non-consecutive occurrences of our current market condition, the upper 5-day band was struck 10.5% of the time. That's a bit lower than the benchmark of 21.5%. Do you see that? The upper 10-day band struck 10% of the time, a bit lower than the benchmark of 15.9. And the upper 15-day band was struck 9% of the time, again, quite a bit lower. So this is a picture of certainly that the upper bands do not get struck near as often as the benchmark when this condition comes around. Now on the downside, the lower 5-day bands were struck 11%, the lower 10, look at that, 17.5%. That's actually a little bit higher than the benchmark. You see that? It's pretty much right on it, but a little bit higher. The lower 15-day band, 15.5 again, which is lower. So 5 of the 6 bands were struck less often. So what's this a picture of? This is a picture of lower market volatility with a slight bias to the downside. The upper bands are getting struck far less often. The lower bands get struck less often, but not to the same magnitude as the upside bands. So that's the overall conclusion. Now what I do is I also look at those instances where the previous day's bar was exceeded to the upside. The high of the preceding bar was exceeded. And we ask ourselves our question, what is the distribution in the cases where Monday comes, the market opens, and market goes above Friday's high in this case? What's the distribution in that particular instance? And in that instance, very similar, where 5 of the 6 bands are getting struck less often with a bias to the downside. See, look at that, 8%, 11, 11, okay, and then these are struck a bit more often. 2 of those 3 are struck a bit more often. So the same conclusion in that particular case. Now, of the 92 times when the market descended below Friday's low, in our case, okay, if the market goes down, exceeds the previous day's low, now you have a situation where 4 of the 6 bands are getting struck less often. You do not have the same bias to the downside in that particular case when you study these numbers. Okay, it's a picture of lower market volatility in general with no bias to either direction. Okie dokie. So that is that for that report. I hope all this information has been very helpful. I'm Steve Lentz with Discover Options. Thank you for listening. Good luck trading this week. Take care. Bye-bye.